Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically loan documentation. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Loan documentation. Now, loan policies will define the necessary documentation and information, what type of documentation it is, how frequency, and so forth, that will be required at loan origination and throughout the life of the credit. Appropriate and accurate loan documentation will help ensure the creditor is lending in a safe and sound manner. The creditor will maintain the original loan documents, their exhibits, and required original signatures. The information is used by the lending officer and loan committee, as well as auditors and other external parties like regulators. And information will be used to verify the identity of the borrower and the signers, their historical and current financial condition, the purpose of the loan or loans, the primary and secondary sources of repayment, and the collateral used to secure the loan. This includes financial statements, credit reports, appraisals, everything. Files will also include the ongoing receipt of financial statement reporting, the creditor analysis, collateral inspections and field visits, and loan covenant monitoring. These data will serve as a basis for establishing the borrower's creditworthiness and serve as a paper trail for external auditors and regulatory examiners to review. When I say paper trail, obviously most institutions have electronic files at this point. And now, loan documentation will be used to service the loan. The credit file will also include documentation for collateral lien perfection and collateral monitoring. If there are third-party contractual agreements with contractors or franchisors, the creditor will have taken an assignment of those contracts in the event the debtor defaults on the loan. With proper documentation and internal controls, the creditor will be able to ensure that any collateral is released back to the borrower at the appropriate time. Negotiable collateral, like a certificate of deposit, will be maintained under dual control by individuals that are independent of the loan function. A well-managed credit risk management function will also enable the creditor to service the debtor adequately even when the debtor's loan officer is no longer at the financial institution. Besides the promissory note, a risk-based loan agreement, that's used to control the borrower's financial performance, often including performance-based covenants, reporting, and affirmative measures and negative restrictions. Performance covenants should be adequately structured, hopefully, to give the debtor sufficient appropriate room to operate his business before a violation is triggered as economic conditions deteriorate. There has to be just the right amount of headroom. The close monitoring puts the creditor in a position to accelerate or demand full loan repayment if necessary. So why is loan documentation important to you? First of all, take the time to read and discuss and understand your loan documents if you haven't already. Creditors need appropriate file documentation not only at origination but throughout the lending relationship. They also are required to operate in a safe and sound manner, and understanding your financial condition while the loan remains unpaid is critical. Your loan documentation will likely require you to provide more ongoing reporting than you may think is reasonable or necessary, especially if you're experiencing financial difficulties. After all, you say like the money's been advanced, so why doesn't the creditor just leave you alone? Maybe you're wondering why a residential mortgage lender, for example, who booked a loan many, many years ago, doesn't need additional documentation, but your creditor does? As you know, consumer loans have their own underwriting requirements, but your business loan has a much higher risk profile. The loan documents will ensure the creditor gets what it wants. It may feel like you're trapped in a corner, and someone is telling you, if you don't like it, you don't have to borrow the money and just pay it off, right? Financial institutions are required to lend money in a safe and sound manner, as most of them have similar lending and underwriting requirements. You may just need to spend some more time reading the loan documents, so see what they really mean. Non-regulated creditors may have different standards, but their interest rates and fees may be much higher because of the increased credit risk they're willing to take. That said, when you sign any loan documents, give yourself sufficient time to read or discuss or at least understand what it is that you're signing. A serious business owner will do this and conform to any requirements. Not so astute business owners will just sign anyway and run the risk of mismanaging the business itself. The latter approach will likely result in a headache for the creditor should there be a decline in financial performance. How sharp is your pencil? How serious are you as a business owner? In the end, you'll get what you want and deserve, frankly. Be judicious and smart when it comes to comprehending what your loan documents say and what's required. Read it, understand it, know it. At a loan origination or loan closing, don't be too rushed. It's your business, so take better care and ownership of it, whatever it takes, by carefully understanding your loan documents. Ask whatever questions you think you should, regardless of how much time it takes. Make sure you literally know what the creditor's expectations are, what the due dates are, what the covenants mean, and how they're calculated, and everything else. Chances are you'll be much more successful because when difficult economic periods come, and they do, and they will, you will have established a relationship of trust, respect, and mutual confidence with the creditor. Bottom line, you're going to need that relationship when your financial performance is less than what both parties expect. Thank you for joining us. Today we covered the Creditor Tool, loan documents, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps other small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.